Today, we're diving into a fascinating paradox at the heart of China's semiconductor industry. And that paradox is a company called NSIG. Now, on one hand, it's the nation's undisputed leader in silicon wafers. But on the other, its financial statements show significant and frankly widening losses. This isn't a story of failure. Instead, what we're looking at is the anatomy of a very calculated, very high-stakes strategic investment.
So let's start with the conclusion right up front. NSIG's current financial performance isn't an accident. It's a direct and deliberate consequence of its strategy. You see, the company is deep in what's known as a classic J-curve investment phase. It's absorbing massive upfront costs right now to build a competitive moat for the long term. And this strategy positions it perfectly to catch two powerful tailwinds: the national push for domestic substitution and, of course, the global surge in demand driven by the AI revolution.
To really understand NSIG's strategy, we first have to get a feel for the unique battlefield it's on, a market that's really defined by global giants and powerful domestic mandates.
Now, the global silicon wafer market is a textbook oligopoly. Just look at the data. The top 5 players, we're talking industry leaders like Shin-Etsu and Sumco, they control over 90% of the entire market. In that context, NSIG's global share sitting at around 2% really just underscores the immense capital and technological barriers you have to overcome to even compete at this scale. But this is where the story gets really interesting. A key divergence shows up in the 2024 performance data. You can see here, global wafer shipments actually contracted. They were down nearly 3%. Meanwhile, NSI's revenue grew by over 6%. So what explains this disconnect? Well, it points directly to the powerful impact of domestic substitution, where national policy is effectively insulating the company from these broader global cycles. And this growth is really being powered by two distinct engines. First, you have massive capital expenditure from China's domestic semiconductor fabs, which creates a very stable pool of demand for NSIG. And second, you've got the huge secular growth trend of artificial intelligence. That's driving this incredible demand for high-performance computing, which in turn requires the very same advanced 300mm wafers that are absolutely central to NSIG's entire strategy. Okay, so let's shift focus to the company itself. We're going to deconstruct this J-curve and see how its strengths and weaknesses are really just two sides of the same strategic coin. The J-curve effect is absolutely central to this entire analysis. It basically describes a trajectory where you have huge upfront investments that lead to a period of negative returns. That's the bottom of the J. But this is followed by a sharp inflection point and then rapid, even exponential growth as those investments finally start to pay off. Our assessment puts NSIG deep in that initial trough of the curve right now. This slide really lays it out perfectly. On one side, you have the strengths: clear technological leadership in advanced wafers, a comprehensive product portfolio, and really high switching costs for its customers. But on the other side, you see the direct consequences of being in that investment phase. Very weak profitability, a negative gross margin, a major scale gap compared to its global peers, and just immense financial pressure from all that capital spending. And if you look at the domestic competition, it just reinforces this point. TCL Zhonghuan is in the space, sure, but its main business is in photovoltaics, which, by the way, is suffering massive losses right now. Its semiconductor unit is almost a side project. This contrast really highlights NSIG's strategic clarity. In fact, you could argue that TCL's struggles just validate how incredibly high the technological and financial barriers to entry are in this very specialized field. All right, let's turn to the financials, because this is where the J-curve effect stops being a concept and becomes a story told in hard numbers. This table shows that clear divergence we've been talking about. Just look at the revenue line. It's relatively stable, even showing some growth. Now look at the net profit line. It's a dramatic decline, from a small profit straight into a significant and widening loss. So in 2024, revenue grew a pretty respectable 6.18%, which actually defied the global market downturn. The top line here is showing real resilience. But in that very same year, the company posted a net loss of nearly 1 billion yuan. That sharp contrast between top-line growth and a bottom-line collapse, well, that demands an explanation. And the explanation is right here. The losses are being driven by three key things: soaring depreciation costs as these massive new facilities come online, sustained intensive R&D to maintain that technological edge, and continued price pressure from a global market that still hasn't fully recovered. These aren't signs of a failing business. These are the direct, quantifiable costs of executing the J-curve strategy. Now, if we really want to dig in, the DuPont analysis breaks this down even further. It shows us that return on equity is absolutely plummeted, and it's because of two key factors: a total collapse in the net profit margin and a decline in asset turnover, which means those new assets aren't yet generating revenue efficiently. At the very same time, the equity multiplier is rising, which tells us the company is using more debt to finance this expansion. This right here, this is the financial signature of a company in a high-investment, pre-profitability phase.
So, this entire strategy brings NSIG to a really critical crossroads. Our analysis now has to shift to the path forward and, of course, the key risks that could derail this trajectory.
The path to profitability is actually quite logical. It consists of three key steps. First, they need to ramp up production to get the utilization rates up at their new facilities. Second, they have to use that higher output to absorb those massive fixed depreciation costs. And third, they need to be in a position to capture the upside from an expected recovery in global wafer prices. If those three things happen, that J-curve will begin its sharp upward swing.
However, we have to acknowledge that the risks are substantial. A prolonged industry downturn could delay that price recovery. Any operational setbacks in improving their manufacturing yields could keep costs stubbornly high. Sustained losses, obviously, create significant pressure on cash flow. And finally, geopolitical risk is always a factor, with the potential for restrictions on access to critical equipment or materials. And all of this brings us to the central unanswered question. NSIG is playing the long game here, sacrificing today's profits for what it hopes will be tomorrow's market dominance. But the entire strategy really hinges on one critical unknown. In the face of this immense financial pressure, can the company's strategic patience outlast the market's inherent and often brutal cyclical volatility?